If I took away your job, your contacts, and your savings, which asset class would I use to rebuild wealth fastest? Not the stock market. Real estate, used intelligently, still gives you levers. Other investments simply can't match, and in a few minutes, I'll show you a simple framework that reveals exactly when property beats everything else and when it doesn't. I'm Simon. Years ago, I rebuilt from near zero after a business failure, and real estate played a central role in that rebuilding. Not because it's easy, but because it lets ordinary people control valuable assets with limited capital, protect against inflation, and create repeatable cash flow. The trick is understanding how the game actually works and avoiding the traps that swallow beginners. Here's the first pattern most people miss. Property pays you in 4 different ways at the same time: monthly cash flow, loan paydown by your tenants, long-term appreciation driven by productivity and population growth, and powerful tax efficiencies that boost your net returns. No other mainstream asset offers that exact stack. But there's a catch, and we'll open that up shortly. Let's address the myth head-on. House prices always go up. They don't. Markets cool, rents wobble, costs surprise you. As Ray Dalio puts it, risk comes from not knowing what you're doing. In property, risk concentrates in poor underwriting and rosy assumptions. So here's a fast discipline I use. I underwrite every deal on today's rent, not tomorrow's dream. I stress test vacancies and repairs. If the numbers still stand up, only then do I look at upside. Later I'll give you the exact stress tests I apply before making an offer. But here's what's truly fascinating. In real estate, time becomes your business partner. Even a modest, fairly purchased property can compound beautifully, because each month your tenant chips away at the debt, slowly handing you equity. Benjamin Franklin said, "Beware of little expenses. A small leak will sink a great ship." Reverse that principle and you get real estate. Small, steady credits floating the ship higher, provided you plug the leaks. So, is property still the fastest path to wealth? It can be, if you don't confuse speed with speculation. Quick flips look glamorous, but the consistent winners I've met master boring systems, buying below intrinsic value, improving management, and repeating. Seneca wrote, "Luck is what happens when preparation meets opportunity." In property, preparation is a proven acquisition checklist, reliable contractors, and conservative financing. Opportunity arrives as mispriced deals, tired landlords, or properties with solvable problems. Let me share a simple real-world pattern I used while rebuilding. I focused on value-add rentals in working neighborhoods with stable demand, close to jobs, transport, and schools. I didn't chase perfect kitchens. I chased under-market rents and operational inefficiency. I added laundry, improved lighting, negotiated utility charges fairly, and tightened maintenance. No heroics, just fundamentals. Cash flow rose, refinancing unlocked equity, and the flywheel began to spin. A quick interruption, because this matters. Your financing choice can make or break the deal. Fixed-rate debt turns rent into something closer to an annuity. Floating rates demand sharper management and bigger reserves. Warren Buffett reminds us, it's only when the tide goes out that you discover who's been swimming naked. Reserves keep your swimsuit on. I never buy without a dedicated repair fund and a multi-month buffer for vacancies and rate shocks. Now, what about people starting with very little? The instinct is to say, I can't buy anything. but you might be able to control value before you own it. You can partner with capital if you bring deals, analysis, and management. You can secure rent-to-rent or master lease opportunities, improve operations, and capture a spread. You can learn to spot zoning quirks or layout changes that unlock an extra bedroom. Real estate rewards problem solvers more than check writers. Still skeptical? Consider the leverage of specialized knowledge. Peter Lynch said, "Know what you own and know why you own it." In property, that means understanding one submarket so well you can price a listing in your head while you're still in the car. When you achieve that local clarity, you stop buying a house and start buying cash flows, contracts, and optionality. That's when wealth can accelerate. Before we go further, a warning that could save you years. The fastest way to lose money in real estate is to outsource your thinking. Agents, contractors, managers, they're vital partners. But the investor is the chief risk officer. Your edge is disciplined underwriting, patient deal flow, and calm temperament when others chase hype. In a moment, I'll reveal my 2-minute underwriting filter, the 5 numbers I punch in before I ever step into a viewing, and the exact deal sources that brought me the highest return properties after my bankruptcy. Stay with me, because those numbers decide whether property will be your fastest path to wealth or a very expensive lesson. Here's the filter I still use today before I ever set foot inside a property. Purchase price, expected monthly rent, estimated repairs, annual property taxes, and insurance costs. With those 5 figures, I can calculate my true yield in minutes. If that number doesn't hit my minimum threshold, after stress testing for vacancies and maintenance, I pass, no matter how pretty the kitchen or how hot the market looks. Discipline here will save you from chasing deals that bleed cash the moment you close. Once a property passes that test, the real work begins, due diligence. I walk every unit, inspect every system, review tenant payment histories, and check local regulations. In the UK and US alike, a single compliance issue can wipe out months of profit. Charlie Munger put it bluntly, "It's not supposed to be easy. Anyone who finds it easy is stupid." In real estate, the profits live in the details most people skip. Now let's address timing, because I often hear, "Simon, isn't the market too expensive right now?" The truth, there's no perfect market, only the right strategy for current conditions. In a rising market, focus on securing fixed-rate debt and locking in affordable payments. In a cooling market, keep cash reserves ready and negotiate harder. In stagnant markets, target value-add plays that create equity independent of price trends. One of the most underrated wealth accelerators in real estate is forced appreciation, raising a property's value by improving its income, not just waiting for the market. I've seen ordinary 2-bed flats become wealth machines by adding a bedroom, installing energy-efficient upgrades to reduce costs, or converting unused storage into rentable space. Each improvement boosts income, which in turn increases the property's appraised value. That's money you can access through refinancing, fueling the purchase of your next deal. And here's a truth few admit. Property management will make or break your long-term returns. You can own the best located building in town, but if rent collection is sloppy, maintenance is reactive, and tenant turnover is high, your profits will vanish. Early in my career, I underestimated this and paid the price. Now I either use exceptional managers, paid well and monitored closely, or I systemize my own management with clear processes, regular inspections, and fast maintenance response times. Let's not ignore the tax advantages, because they can supercharge your net returns. In the UK, structures like limited companies can offset expenses and manage capital gains. In the US, depreciation shields a portion of your rental income from tax, even while your property's market value rises. As Robert Kiyosaki says, it's not what you earn, it's what you keep. The right ownership structure and tax strategy can be as valuable as a great deal. For those starting small, house hacking, living in one unit while renting out the others remains one of the fastest ways to break into property. It slashes your living costs while your tenants help pay down the mortgage. I know young investors who repeated this strategy every few years, building impressive portfolios before age 30 without ever paying full market rent themselves. Partnerships can also accelerate your path, but only with clear agreements and aligned goals. I've seen partnerships create fortunes and destroy friendships. Treat them like a business marriage. Put everything in writing, from exit strategies to decision-making authority. Here's the mindset shift that turns property from an investment into a wealth-building machine. Stop thinking of yourself as a buyer of bricks and mortar, and start thinking of yourself as the CEO of a cash flow business. Every decision, financing, renovations, tenant selection, should be measured against its impact on sustainable long-term profit. To close, I'll leave you with a personal lesson. After my bankruptcy, I bought a small, under-market flat in a good rental area. It wasn't glamorous, but it was solid. I managed it tightly, improved it modestly, refinanced to pull out equity, and used that to buy the next property. That one flat became 4 over several years, each one feeding the next. It wasn't quick riches, but it was unstoppable momentum. As Andrew Carnegie famously said, 90% of all millionaires become so through owning real estate. The vehicle hasn't changed, the road has. Drive it with knowledge, patience, and discipline, and it can still be your fastest path to wealth. Now, I'd like to hear from you. Are you already investing in property? Or is it something you've been hesitant to start? What's holding you back? Drop your thoughts in the comments. I read every single one because your success truly matters to me.